Hey guys, TommyBryson here, and this video right here is super important because for the first time in the past 3 years, I'm going to be changing my investment strategy. And honestly guys, I am the type of person that before I make a decision, I do all the research, I read all the books, I watch all the videos because that's just the way I am. But one thing I never want to be is the person that is never open to new, better ideas. So the truth is, I found a better strategy that's gonna make me even more money, so I gotta adjust. And that's exactly what I'm gonna tell you guys about in this video. I don't wanna be like the old guy that has a horse for the longest time, and now he refuses to go ahead and basically buy a car because cars are just not for him, although it would get him from point A to point B a lot faster. Now, here is the truth. My old investment strategy is not that it's bad. It is still pretty good, pretty solid. It's very well diversified. It makes you a good amount of money, but it has one thing, a lot of safety nets, maybe a few too many. It's like riding a bike for the first time with training wheels, helmet, knee pads, and then wrapping yourself with bubble tape. What's that called? Like bubble wrap, just in case you fall, you don't hit yourself or hurt yourself. Now, when you first start, obviously, it's important you take care of yourself, especially with investing. But once you understand the game of investing, you don't have to take all of those precautions. So that's what's going on, okay, guys? The old portfolio is great when you're first gonna start it. But once you fully understand it, for me, it took me 3 years to build confidence in this portfolio. Well, now it's time to change things up. And by the way, yes, this new portfolio of mine is still passive. It can still be automated. And most importantly, it makes us a lot more money. And that's why I'm here making this video. That way, you guys also make a lot more money. Long-term team for the win, obviously. Now, if you guys are new here, subscribe, hit the bell so you're notified. And on top of that, also smash the like button. It helps a lot. So thank you guys so much. And by the way, smash it, smash it, smash it. Turn it from gray to blue. That's my new intro right there. It kind of sucks, but I like it. So now guys, the very first thing is this. Money talks. So let's talk money before I tell you exactly what I invest into, the app I use, and why I changed the whole thing, okay? Now, the first thing is I want to compare my old portfolio, okay, with my new portfolio and tell you exactly what the difference actually is. And by the way, here's the old pie, basically my old portfolio, and here's my new portfolio, the old pie, okay, or the new pie, I should say. And by the way, just to make something very clear, am I saying, Tommy, is this new portfolio going to make you thousands more? The answer is yes, okay? Because by the way, in investing, just a 1% difference can make you tens of extra $1,000 with compound interest and a long time between it, okay? That's the idea. Now, for context here, to compare it in a fair way, if you started investing today, $1,000, and you said, well, Tommy, I'm going to max out my Roth IRA for the next 10 years, okay? And by the way, to do that, you only need to invest around $117 per week. That's the idea. Now, if you did this for 10 years, the old portfolio would make you $110,000. That's around $50,000 profit right there. Honestly, not bad. But the new portfolio would make you $117,000. Tommy, so you're telling me the new one only makes $7,000 extra in 10 years? What's the point? It makes no sense, okay? Well, it does make sense because remember, in investing, a 1% difference can make a hell of a lot more money, all right? So although in the short term, 10 years, by the way, yeah, I consider that short term because long-term team is 20, 30, 40 years. It might not seem like a lot, but in the long term, it's gonna make you a lot more money. For example, guys, okay? If you continue your investment strategy for 40 years in total, the old portfolio would make you around 3.35 million, okay? A lot of money, obviously. But the new portfolio, okay, would make you $4.53 million, an extra $1.2 million. Now that's what I mean, okay? In the short term, just 10 years, 7K does not seem like a big deal. But in the long term, 30, 40 years, $1.2 million is a lot of extra money. And by the way, if you follow exactly what we do here, remember guys, okay, using the 4% rule, that $1.2 million extra gives us around $40,000 every single year in passive income. So obviously, that 1% is going to make a massive difference. And that's one of the key takeaways why I switched portfolios, because guess what? We're gonna make a lot more money. I'm gonna tell you exactly how, what I invest into just in a second. But by the way, guys, if you find out and you're like, Tommy, I don't wanna do this, just remember one thing, okay, guys? Remember that 1% in the stock market means a lot. So don't just hand your money over to an investment manager and they're like, hey, we're gonna cost you 1%, 2%, because again, that 1 to 2% in this example right here equals 1.2 million in the long term. So don't just give away your money. Watch this video fully. That way you know exactly how to do it on your own, and you don't need this manager here or that manager there. Now, before I tell you exactly portfolio, I want to answer 4 questions here because I know I'm going to get them. So first of all, guys, okay, the first thing is this portfolio. What is it made of, Tommy? Are you investing into Apple? Yes. Tesla? Yes. Into Microsoft? Yes. Are you picking them individually? No. The truth is, I'm investing into an ETF portfolio based on index funds, okay? Now, Tommy, in English, what does this mean exactly? Well, an index fund is just a type of mutual fund. A mutual fund, listen here, this is important, okay, because I don't want to skip anything, so let's just break it down, okay? A mutual fund is when a bunch of people pool in money together and give this money to a manager. And the manager is trying to do one thing, okay? Not just a manager, but like a manager, the whole team, and the company. And they're trying to beat the market, outperform the market overall. They do this by doing research, buying and selling at the right times, what they actually think, and do this over and over again, which makes it more risky and also more expensive. And the fact is, most of them do not outperform the market. So that's not what I do. What I do is, for example, is index fund investing. The difference is all of us, same thing. We pool money together and we give it to a manager. But this manager just has one job. He is trying, or she is trying, to track the overall market. So what does he do? He goes ahead and buys the correct investments to track the overall market, and he basically just buys and holds. No selling or anything, meaning we have less fees and also less volatility, okay? Because it's not based on his intelligence, it's just based on the overall market. If the market made 10% that year, we'll make around 10%. If it went negative, we'll go negative. But overall, it's gonna save us money and less volatility and less risk. That's what I do. Index fund investing, trying to track the market, not beat the market. And an ETF is just that same exact thing, but traded in the stock market, which basically means prices fluctuate a lot more because of demand and supply, while index funds are traded in-house, for example, with Vanguard, Fidelity, Schwab's, and a bunch of other places, okay? That's the overall idea. I just wanted to answer that question so that way you guys know exactly what I'm doing. I'm not picking individual companies. I'm investing into index funds, okay? Or ETFs, okay? That's the whole idea right there. Now, I also want to answer this, okay, guys? Tommy, is the new portfolio going to be as diversified? The answer is yes. It is still diversified, meaning we are spread around different parts of the market, so that way we don't carry that much risk. We don't want to have our eggs in one basket because 10 to 20, 30, 40 years is a very long time. In that amount of time, we can have wars and a lot of things can change. So the point is, we want to be diversified. The third question is, Tommy, the money we invest, when can we expect to get it back? The answer is long-term team is 10, 20, 30, 40 years. So the rule is only invest the money you will not need for next 10 to 20, 30 years. Do not try to invest money today and get the money out before you have to pay rent because you need a profit. It's not going to work. That's not what I'm doing here. So if you want that, that's not this video. I'll make more videos on that later, but that's not this video right here. And the last question is, Tommy, the portfolio, Can it be fully automated and passive income? The answer is yes. It is still fully automated and it's still going to be passive income. Don't worry about that. And yes, we're still going to use the 4% rule, meaning we take 4% of the overall portfolio value once we get to our goal to basically live off of that 4% per year. Meaning, if my portfolio has $1 million, 4% of that is $40,000 per year. I can live on that. The next year, take out 4% more. Why 4%? Because that way we never run out of money because we make more than we spend, thus we never run out. Those are the main questions I wanted to answer first. Now, let me show you exactly the portfolio, what I'm investing into, and everything. If you made it to this point right here, comment down below, let me know. All right, guys, so right here, I am on my cell phone. I'm gonna swipe right, swipe left. This is my phone right here. Now, I'm gonna show you everything about my portfolio and how I'm going to use the new one right now today with you guys right now. Again, you do what you teach, you do what you preach, okay? I'm not here to give you a strategy and not do it myself. No, I'm actually doing this, and that's why I'm sharing with you guys in order so you can actually make money as much as I'm going to make also. So right here, guys, the app I'm using to invest is called M1 Finance. I use it because it's good, it's automated, it's passive, and they have great customer service. I like it, and it's also free. You don't have to pay for the extra features, ignore them, okay? But M1 Finance is the app I use. And if you go down below, click the link in my description, click it, it shows you exactly what I invest into. You can invest into it, and you also get free money by using my link. And I get free money too, so there's that. Now, it's not a sponsored video, so don't worry about that. But overall, guys, this right here is my old portfolio. As you can see, it still makes me a good amount of money, okay? So let's click it, boom. This portfolio right here has 7 different investments overall in total. And it has a split of 80% stock ETFs and 20% bonds ETF. Bonds are investing into debt, and then stock is you invest into the stock market, different markets and so on, because basically it is index funds, okay? But overall, this is it right here, guys, okay? And overall, it's made me 8.59%. Not that bad at all. However, though, again, the training wheels example. The problem is the old portfolio, it does great. It is awesome. And I highly recommend it if you're first getting started. Use this portfolio right here until you fully understand what you're doing. Don't change just yet. If it's your first time investing, don't change just yet. Just use this old portfolio right here. I'll have a pop-up right here with the whole like pie and the split, the allocation for the old portfolio. Here it is right here. The new portfolio, the problem is this, guys, okay? The new portfolio takes on a different level of risk. Not that risky, but it is different. Because look at this, guys, okay? The old portfolio has 2 main different things, okay, guys? It has bonds. That's the main thing here. It has bonds. It has treasury bonds, and it also has corporate bonds. That's all just that. And as you can see, guys, so far, they don't make you that much money whatsoever because these bonds right here are just to keep your portfolio stable. So usually when stocks go up, bonds kind of stay the same, or they also just go just right here, okay? So stocks go up, bonds stay the same, or they go sometimes even lower. When bonds go up, stocks go down, okay? Or it might stay the same, okay? But usually it's like a seesaw. One goes up, one goes down. And what happens is it keeps everything level so that way you don't get too fearful. So for example, 2020 last year, pandemic happens, stock market crashes. But guess what? While everyone lost 20 to 50%, I was only down around 13 to 15%. That was it because I had bonds in my portfolio and that gave me confidence in my portfolio. But once I know exactly how investing works, I don't need those training wheels, the knee pads, the bubble wrap. I don't need all those things because I know exactly that, hey, it's for the long term. So this correction, this sharp drop is not gonna make me want to go ahead and sell my investments. You know, actually, 2020, I bought more stocks when I was actually losing money because obviously that's what you do. So that's what I did, okay? But overall, the new portfolio is going to get rid of the bonds and use that extra 20% to put it obviously into the stock parts of the index funds, for example, or the index ETFs. That's the overall difference. Now, as you can see, guys, okay, right here is a graph that shows me exactly the performance over the last 10 years. The red is basically the new portfolio. The blue is the old portfolio. And the yellow is 50% stocks, 50% bonds, a very conservative one. I don't recommend it whatsoever. It makes very, very little money, like nothing. Unless you're like a millionaire already and you don't want to invest any money at all, okay? That's the idea. But overall, guys, okay, when times are bad, portfolio does very bad, okay? But the old one, it doesn't do that bad. When times are good, new portfolio does. The new one is always going to outperform the old one on average. When times are bad, we're always going to do just a little bit worse than the old one, okay? Because again, the old just getting started, so that way you don't get that scared when the market does go down like crazy. But once you fully understand and comprehend, it is okay, because you know, hey, guess what? Although we're doing bad right now, most likely is going to average out in the next 10, 20, 30 years. Long-term team, right? That's the idea. So we're always going to do better overall. So Tommy, what's the big difference, okay, mathematically? Well, on average, in the past 10 years, for example, the old portfolio makes around 10.44%, not including the dividend and reinvesting the dividends, okay? The new portfolio makes around 11.49%. Well, Tommy, that's not that much. It's only 0.05% more, all right? Yeah, it is a lot. Because remember, that 1.05% makes an extra $1.2 million in 30 to 40 years. So it's going to be a big, big difference. So Tommy, what is the new portfolio now, okay? What's the allocation for it? Well, right here, guys, I created like this little graph. So if you want to look at it right here, here it is. So right here it is, okay, guys? So the new portfolio, guys, is what I called the aggressive portfolio, okay? It only has 5 investments, and that's basically the same ones as before, but only stocks, basically. And we would do 40% into the S&P 500, basically the 500 largest companies in the US, 20% into the international developed markets. So that's like Toyota, China, Europe, and all those companies right there outside of America. Because again, 30, 40 years, if we have a war, America might not be the superpower. So we want to be diversified. On top of that, we have VB, 20% of that also. Why? Because we want money in small cap companies, because usually the smaller companies are going to have the largest growth. That's just common sense. And then we also want money in emerging stocks. Because why? Because smaller industries out there have a lot of potential for risk, but also have a lot of potential for a lot more gain. That's why we also want this. And then lastly, VNQ is into real estate, around 10%. Why? Because the stock market is down. We want to make sure we have a different sector that does not relate to the stock market that much. So that way we have kind of like a little level field, so that way we don't carry that much risk. That is the overall idea of the new portfolio. While the old one, for example, right here, moderately aggressive, guess what? We had 7 investments, and it had, for example, 20% into bonds, which we don't need anymore, because in reality, we don't need those training wheels. So right now, live with you, I'm going to go into my M1 Finance portfolio. So here it is. All I have to do is just click Manage My Pie, click right here where it says Edit Pie, and switch to targets. So the new targets are going to be 40% for VOO, okay? 20% for VEA, 20% for VB, 0 bonds. Wow, no more bonds anymore. So by the way, it's going to remove around 50K of my portfolio and reinvest it back into the stocks, okay? That's what's gonna happen here. It kind of scares me, honestly. It's like when you first ride a bike again, you're like, I know how to ride, but you know what I'm saying? But if you understand it, you're gonna be just fine. Long-term team for the win. And I'm not going to, for example, if I do this today, tomorrow it drops sharply, guess what? I'm probably going to invest more money. I'm not gonna sell, because again, this is money I don't need for the next 10 to 20, 30 years. That's the idea here. And then right here, VNQ increased from 8 to 10%. and VWO from 4% to 10%. And we're going to go ahead and click, for example, save. And boom, that is it. So Acorns, moderately aggressive, is going to change right here. It shows me everything is being updated. To confirm, we have 40% to VOO, yes. 20% to VB, yes. 20% to VEA, yes. 10-10, yes. So that is it right there, guys. Okay, so click confirm and boom. And that's it right there. So just like that, what's going to happen is it is going to remove those slices and it's going to invest that money, for example, into my stock portfolio now. Okay, that's the idea. But overall, guys, that is it. That is a new portfolio idea. This portfolio is going to make a lot more money when times are good. When times are bad, it's going to lose a little bit more money. But the idea is, since you understand it, don't panic, don't go crazy, don't sell anything. Just hold on to your pants and just say, hey, I understand, I comprehend. Let it do its thing and just invest more money if you have anything extra. And by the way, common sense here, my common rule is, if you're going to be investing, do 10 to 20% of your income every time you get paid. By doing dollar cost average, it means, hey, you're going to buy when months are good, when months are bad. So that way you don't carry that much risk at buying at the peaks. Also, for example, don't invest if you have crazy debt and you have no emergency fund. Yes, I'm investing a lot of money, but again, I have no debt. I have a fully funded emergency account for 6 months. And then I can go ahead and basically invest, because that way I don't have to worry about paying other people. I have money secure, so if I lose my job, so that way I'm good to go. That is the overall idea, guys. Okay. By the way, link down below, click it. You get my portfolio for free. It's not me trying to charge you money for anything. Everything is down below for free. Hopefully this helps right here. And one piece of advice, guys, okay? Make M1 Finance. If you're going to use it, do it automatically for you. So whenever you get paid, it gets the money automatically and invests the money automatically for you. So that way you don't have to think about it anymore. But that is my new portfolio, which is going to make me approximately a lot more money. Although it just makes an extra 1.04% right now, in the end, it's going to make a lot more money. See you guys tomorrow. Thanks for watching. Comment down below any ideas. And as always, subscribe to the channel, hit the bell so you're notified, like this video, and also DM me on Instagram, TommyBryson, or if you want to talk to me, call me. The link is down below. And on top of that, also watch more content here. Click my face right here. And as always, peace. Long-term team for the win. Love you guys. I'm out.